Managing Partner, Key Advisors Group. There are some long-term strategies here and some blue chip names that you watch closely. Tell me more. What's in your brain here, Eddie?
So look, dividend stocks, they're not real sexy and doesn't get a lot of attention like a Tesla or like a GameStop, but dividends have proven over time to be one of the best ways to accumulate wealth through dividend reinvestment. A lot of investors have been very successful in doing that. The other thing too, when it comes to retirees, which I work with a lot of retirees, is many times for the right client with the right risk tolerance, it's a great way to generate income. If you can build a basket of portfolios that the dividend yield itself covers all of your disposable income needs, then the ups and downs of the equity doesn't really impact or change anything in your life because all you care about at that point in time is the income. And so that's why dividends are very, very powerful, in my opinion, is it can eliminate someone from making emotional decisions, because if your entire portfolio is based on capital appreciation and you get a 20 or 30% drop, many times investors don't have the stomach to be able to do that, and then they'll sell at the wrong time. Dividends kind of smooth out the ride, in my opinion. And right now, you look in the energy space, you look in the banks, not only do you get the dividend yield there that's very attractive in some of those areas, but in my opinion, some tremendous upside on the appreciation. So it's a great way to balance out a portfolio. I've always been a big fan of dividends. And if you can get some appreciation on top of that, that's a bonus.
Right, and I'm sure you would say all your whole portfolio doesn't need to be dividend stocks. Tell me more about certain sectors that you like. There's one in particular I know you like a lot.
Yeah, so we came into this year, we love the energy sector because we really feel like oil is going to continue to run up. We could see it hit $75 to $80 a barrel by summertime, is our opinion. We love anything tied to the consumer spending. We think the acceleration on the consumer spending numbers over the next 3 months as we open up this country and people get vaccinated, it'll be some of the highest ever recorded. And so anything tied to the consumer on the cyclical side is really where you need to be, because the market is completely underweight energy and those cyclicals. And that's why, in my opinion, you're really seeing the rotation out of tech. It's not because interest rates are going up. It's because everyone owns those companies. So in order to rotate into cyclicals and energy that the market came in underweight, you have to sell some of those technology companies that are so highly owned. So I think that trend's going to continue for the next 4 to 5 months in regards to cyclicals, far beating out the broader market.
Yeah, so just expand on that tech thought, because I know you have some sectors that maybe you would say stay away from, or maybe at this point you take some profits. Expand on technology or add in anything else that you're a little wary of at this point.
We've stayed away from utilities. We don't really like gold right here. We don't like consumer staples. Those are areas that are not going to work when we are in an inflationary and risk-on environment. So anything tied to inflation is going to do really well, in our opinion, over the next few months. And so basically, the higher beta, higher risk plays have been outperforming by a wide margin so far this year. And again, we think that trend's going to continue. You look at a day like today where the NASDAQ got clobbered, the high beta stocks like airlines, for example, had an awesome day. Energy was stable. And so again, that's been pretty consistent, but it's almost like the market doesn't want to believe it. But we think this trend is here to stay through the summer months.
Right. And what's the final takeaway? Because we're going to see interest rates fluctuating. We see a reopening of our economy, stimulus now, which seems to be going through. You have the Senate pass. It's got to just go back to the House quickly. And things are looking better, right? So how much of an investment should people be making at this point? And for how long, right? Is this a 1 year, a 3 year, a 10-year investment?
Well, look, investing is a long-term game, right? Even though we think that the next few months are going to be very, very prosperous, make no mistake, we are in a bubble right now. And we've told our clients we will probably, based on the rate of acceleration that we're going to see, we think there could be some huge returns in the next 4 months. But come fourth quarter this year, we may be de-risking because this bubble will only get so big before it starts to crack and then ultimately pop. And I'd rather de-risk before it pops than after.
Right. Yeah. Eddie Ghabour, thank you. Managing
Thank you.
partner at Key Advisors Group. It's great to see you. I really appreciate it.